But joining us now is Aadil Zaman, who's partner at the Wall Street Alliance Group. Are we going to make a record? It's, a bland question, but we can't help ourselves at this time of year.
Yes, I think it is likely because the Fed waged a war against inflation and it won that war. The economy is doing well, inflation is down. We anticipate that going into next year, this rally is going to continue because of upcoming rate cuts. And although because we've come up so much in such a short period of time, don't be surprised if we get some type of a pullback in the first quarter of next year. But people that have missed out on the rally, we think that is going to be an opportunity to take advantage of.
In what sense? So if you missed out on the rally, and we're looking at the Magnificent Seven, let's say, the Nasdaq 100 up 54% this year. I mean, if you missed out on that, would you really test those waters next year?
I think the Magnificent Seven is going to continue to be magnificent because just in this environment that we are in, with an increased focus on artificial intelligence and cloud, I think some of those stocks will still have momentum to go ahead further, especially on a pullback. But we do think that the breadth in the market is going to improve, and there's going to be the skinny bull market is going to fatten up a little, and other sectors are going to participate. And we really feel that some of the yield-hungry investors, because of rate cuts, are going to gravitate towards the dividend-paying companies. So a recurring theme for us going into next year is to take advantage of some of those good quality dividend-paying stocks.
You have started to see the breadth of the market really start to broaden. You think about the Russell 2000 today alone. I look at the growth versus value in the Russell 2000, and even that gap has started to narrow in recent weeks. Do you think that continues, or do you think that there is going to just be more emphasis placed on where the herd has already been going, the semiconductor stocks, the AI boom, and those Magnificent Sevens?
I think it's going to be pretty much all of that, right? I think that, probably the speed at which the tech stocks have gone up, that's going to slow down. But I think the tech stocks are going to continue to do well, right? But I think there's going to be greater participation from other sectors. Like, for example, right now, the cheapest sector in the market is the energy sector, right? And with rate cuts, the demand for oil is going to go up. Prices of oil, we anticipate, are going to go higher. And there's going to be supply constraints because of geopolitical factors, because of OPEC production cuts. And we do feel that, there's consolidation going on in that space, which you just spoke about. And I think that's going to benefit some of the big players.
How do you play the energy sector at this point in time? And what are the stocks that you would be buying in the sector?
So a stock on our watch list that we really like here is ExxonMobil, right? So through that deal with Pioneer, the merger that they're having, they're going to benefit from economies of scale. And what we will start to see, Exxon itself has said that by 2027, they anticipate that their earnings will double based on average oil price of $60 a barrel. We think oil is going to be a lot higher. So I think that's, and the stock pays a dividend of north of 3%. So I think those type of large companies we feel stand to benefit in this environment.
Aadil, why do you think that oil is going higher? I mean, we're awash in oil, we're awash in natural gas. OPEC said we're cutting, and the market said, okay.
So we think that, if we take a step back, right, and we look at the bigger picture, we think that, this transition away from fossil fuels is going to take time. And with rate cuts, we are going to start to get an economic expansion. And we feel that if you take a longer-term point of view, by 2045, we anticipate that the world economy will more than double, right? And geopolitical constraints will continue, OPEC production cuts will continue. So in the long term, we think that's going to be a driver for oil prices to continue to rise.
What other areas, and are you talking about near-term gains? So like the first couple of quarters before the Fed starts to cut rates and then everyone's attention gets turned elsewhere?
I think that, this breadth in the market has legs. I think it's going to last. We feel that, the sectors that we like are dividend-paying companies across the board, high-quality, good-quality businesses that pay a good dividend, right? So, for example, if we look at a company like McDonald's, which is on our watch list, fantastic business model. I mean, their franchise business, they're getting recurring fee from franchise fee plus rental income, and which is a high-margin business for them. They've done really a great job in the international markets by catering to the local flavors. And if you look at the dividend history of this company, for the past 47 years, year over year, they have increased their dividends. So we think that those are some of the areas that the investors are going to gravitate towards, which have legs here.
There is a lot of optimism embedded in your trades that you are putting forward, but what happens if the market turns? What happens if the job market turns faster or the consumer breaks at a faster rate? What happens to those trades?
I think that, that's definitely always a risk. So what we always recommend to clients is have a well-diversified approach. This concentrated approach may have worked for this past year, but being well-diversified, not only across sectors in the stock market, but I think gold is a great hedge for those type of scenarios, because if there's volatility, if there's geopolitical tensions, gold tends to do well in that environment. And what we like is the Spider Gold ETF, GLD, in client portfolios, which gives that hedge. Also, having some fixed income exposure provides that hedge to portfolios as well in this environment.
How are you entering the fixed income market, and is it purely a hedge or is it an investment at this point?
For us, the fixed income market is mainly a hedge. We do think that as rates go down, fixed income should do well. But for us, fixed income gives stability to the portfolio in volatile times. But for the equity portion of the portfolio, that's where we are focusing on for the growth. And we see a lot of opportunities there.
Anything outside the United States, or are you purely invested in the US? There's a lot of opportunity potentially out there.
Yes, we do think that the global markets should do well, that there's opportunity in some specific areas. We specifically like companies that have the international exposure. We spoke about McDonald's. Another company that is in that same theme would be, for example, Caterpillar, right? So when we cut rates and there's economic demand expansion, there's going to be more construction projects. And that means that a company like Caterpillar, which is the world's largest construction equipment manufacturer, would benefit from it. And then Caterpillar also has a great dividend history. For the past 30 years, year over year, they have increased their dividend, and they have an international presence as well. So that is a stock on our watch list that we also like, that plays. So to answer your question, focusing on good quality companies that give you that indirect international exposure is what we like.
And I notice you're looking at financials as well, but if all these stocks are on your watch list, that means you haven't actually got in yet. Are you waiting for more attractive levels for them?
These stocks are on our client portfolios, in our different client portfolios, but we are also looking for them on pullbacks to add exposure there. So that is why. But yeah, we like all these companies. We do have exposure to them.
Now, we were talking a little bit about kind of the strength of the market going into next year, but the risk. You still can't discount the risk here moving forward. How would a deeper recession start to change your thinking here?
So I think if we go into a deeper recession, obviously the growth area of the market is going to be vulnerable, and obviously some of the big tech, that has had tremendous run-ups, there would be vulnerability there. So the idea is that this is the market where there's a lot of active trading that is going to have to be done. So to trim positions on a rally, to add positions on a pullback, I think actively managing portfolios, rebalancing portfolios, and making sure you're well diversified and not concentrated, those would be the strategies that we would be following to safeguard our clients.
Certainly a trader's market. Our thanks to Aadil Zaman of the Wall Street Alliance Group.